Good morning. Asian markets are mostly positive, bearing the Kospi in Seoul, which is still reeling under the geographical tension. The European markets failed to benefit from the recovery in the US stocks and ended sharply lower. In fact, markets in Italy, Portugal, and Ireland joined Spain and Greece in bear market territory. The FTSE 100 closed below 5,000. German finance minister is reportedly proposing extending the naked short-selling ban to include all German-listed stocks. The bill is due to be discussed next week. Italy has joined Europe's austerity club with deep spending cuts. What this means is that unknown fears remain and randomness is the order of the day. Volatility is very high and so are uncertainties and risks. With the FNO expiry a day away, it just gets only wilder. Any sharp snapback should be used to lighten your mental burden and rather than adding any positions. Amidst all this, we can comfort ourselves with the fact that India's macroeconomic outlook is pretty sound and that monsoons just need to be watched closely. The latest GDP data, which will be out on Monday, will offer some more inputs of ground realities. Though the markets across the world are looking oversold, it is premature to say whether we have seen the worst and are therefore ready to resume the ascent. Wait and watch is the right strategy to deal with the ongoing problems and endure the short-term pain. We cannot completely rule out that we will not see another Tuesday-like bloodbath. It may happen again as Europe is facing a major financial crisis and the euro is under pressure. Other key economies like China, Japan, UK and US also have their own set of issues to overcome. So the overall bias remains weak and may remain so for some time to come, though medium to long-term investors can nibble in quality stocks at lower levels. FIIs remain net sellers, and for the Indian markets to sustain a bounce back from here will require a turnaround in fund flows from the overseas investors. The results to be declared today are Asian Hotels, Bajaj Electricals, Bank of India, BHEL, Cinemax, Dalmia Cement, Emco, SD Aluminium, Everest Canto, Godrej Industries, Gujarat Alkalis, GMDC, GNFC, HPCL, Indian Hotels, Emphasis, Mukund, Northgate Tech, Oil India, REI Agro and Tata Steel. In the first 2 years of the current plan period, the power sector, especially generator projects, saw investments of Rs 2.3 trillion against the projected Rs 1.8 trillion according to preliminary estimates compiled by the Planning Commission. The retail arm of RIL has cut its losses as the new centralized supply chain brought savings and shoppers started spending. Marico announced the acquisition of an aesthetic skincare business of Singapore-based Derma RX Asia Pacific Pte. For an undisclosed sum. Moving on to the recommendations, the derivative strategies are buy Hindalco May 140 call option in the range of Rs 1.90 to 2.10 for the target price of Rs 5.50 for expiry, and buy Jindal Steel in the range of Rs 614 to Rs 616 for a target price of Rs 630, and the stop loss is to be placed at Rs 608. Thank you and have a great day ahead.